What's up, everybody? It's Austin, and Tesla reported some incredible earnings. In today's quick video, we're going to review highlights from the earnings report, an investment firm that thinks Tesla could 10x by 2030, and my reaction and what I'm thinking about doing with Tesla in my portfolio after the earnings report. Stick around. This is going to be a good one. All right. This is the quarter we're talking about, first quarter 2022. Earnings per share of $3.22. They beat by 95 cents. That's a huge beat. Revenue of $18.76 billion, 80% year-over-year growth. They beat by almost $1 billion. So incredible earnings report from a revenue and an earnings per share perspective. And real quick, we'll just cover the key highlights from Tesla's financial summary. Yep, the revenue grew 81% in Q1. That was propelled by growth in vehicle deliveries, increased average selling price, and growth in other parts of the business. Profitability, their operating income improved to $3.6 billion, which was a 19.2% operating margin. This was reached while incurring a stock-based compensation expense attributable to the 2018 CEO award of $48 million in Q1. Operating income was primarily impacted by the following items: growth in vehicle deliveries, increased average selling price, reduced cost of goods, lower stock-based compensation, increase in regulatory credit sales. It was hurt by rising raw material, commodity, logistics, and expedition costs, an increase in operating expenses. They've got $18 billion of cash that was driven by a free cash flow of $2.2 billion, and it was offset by debt repayments of $2.1 billion. Total debt, excluding vehicle and energy product financing, fell to less than $0.1 billion at the end of Q1. So that was the quick summary. They crushed it in sales, and they're driving higher margins, even in the face of a lot of these supply chain challenges. And so what that tells us is that, like they said, they're selling vehicles for more, and they're getting more efficient with production of vehicles, which is crucial to Tesla's future. And this is really a big thing. So in my previous video, I talked about Cathie Wood and ARK's $5,800 bull case scenario for Tesla. Well, there's another firm called Worm Capital that's come out, and they said Tesla could 10x by 2030. And it's funny because on CNBC, Tony Sacconaghi from Bernstein struggled to justify its current valuation and gave it a $450 price target. And if you followed Tesla for any time, you know it's one of the most diabolical stocks on Wall Street. You've got people that thought it was a complete scam and had super low projections, and then you've had these sky high projections as well. Worm Capital put out, which I'll put this in the description, a link to it. They put out a 91 slide deck on their valuation for Tesla, and we're just going to hit the key points here. Okay, Worm Capital believes Tesla has hit an inflection point, so they're in expansion mode, and infrastructure is being built out to sustain 50% year-over-year growth through 2030. That's what they believe. Operating gross and net margins should expand at a healthy rate over time. This chart shows revenue right here growing incredibly fast, gross profit, the green line growing, and net income growing. All things you want to see. Their forecast for Tesla in the 2020s, 50% revenue growth, more than any company of its size and scale in history. That's crazy. It's a big call. The potential to achieve a 20 million vehicle production run rate by year end 2030. That's great. Can they sell those vehicles? We'll see. 40% gross margin at scale. And they believe Tesla shares could offer a 10x return and potentially much more. That's crazy sounding. Their 10x by 2030 valuation assumptions include their current business lines. It does not include Tesla's planned robotaxi network or real-world AI product revenue, each of which have profound upside implications to their model. That's a big difference between this report and ARK's report. ARK, as we talked about, even in the bear case scenario, we're baking in some revenue from other products, whereas this one is not. That means they must be more bullish on vehicle sales, which could be pretty insane as well. Their consumer vehicles are the entry point to develop necessary cash flows to build out new and bigger business lines in the coming years. Energy storage, robo-taxi, software, bots, and more. And Elon Musk, even on the earnings call, said that he thinks the humanoid robot is going to be a bigger business than the car business in the future, which is crazy to think about. It's almost the Amazon model of building out Amazon and then building AWS, except they're saying it's going to be at even a larger scale. They believe EV adoption represents the largest industrial paradigm shift of the 21st century. This is key to their thesis. They believe it will be a winner-take-most market, and Tesla is likely to dominate over time with sustaining advantages, power laws, returns to scale, and compounding network effects. Historical analogies, Google search being the clear winner, and then the Apple iPhone. This is what they believe is Tesla's moat: advanced manufacturing at scale, battery strategy, autonomy and real-world AI, AI training, fast charging infrastructure, global and localized production, top intellectual recruiting, direct-to-consumer business model, integrated software, and brand value. And I don't argue with any of that. I actually believe that those are all competitive advantage that Tesla has. This presentation goes into so much more. Let me know in the comments if you want to see the rest of it, and I'll cover the rest of it. Let's jump into how I'm thinking about Tesla, what I'm thinking about doing with the position. The position's up, thankfully, everything else is down. And what I think a more realistic potential scenario for Tesla is over the next few years. As happy as I would be if this happens, I want to stay grounded in a little bit more reality potentially. And so right now, this is fast graphs. I've built in what analysts, and this is Wall Street, a lot of people and analysts who have really underestimated Tesla's execution previously, so they may still be underestimating that, but let's go off of that and just see what we get to. This has the revenue growth expectations built in based off current estimates from Wall Street analysts. For 2022, 58% growth, 2023, 33% growth, 2024, 19% growth, 2025, 14% growth, 2026, 46% growth, in 2027, 30% growth. Worm Capital thinks they're going to go up 50% per year, so this is much lower than those expected numbers. Right now, the blended price to sales ratio is 17, which is really high. But if it goes out and they hit these numbers to 2027, even if it goes down to a price to sales ratio of 10, which is getting cut by around 40%, then you're still looking at an annualized return of 19% for a 175% total return. If it goes all the way down to a price to sales ratio of 5, you would still, if they hit these targets, you would still be looking at a 5% annualized return. So if we think of this as, unless things totally fail and they basically go bankrupt or production shuts down or whatever, and they hit these kind of like minimum expectations of analysts, and there's pretty insane multiple compression all the way down from a price to sales ratio of 17, which is a measurement of the price of the stock compared to their sales, all the way down to 5, then you're still looking at the potential for a positive return. And if Tesla continues to defy gravity and Cathie Wood and Worm Capital are correct and there's a lot more upside there, then you have the potential to make a lot more money. And so the question becomes, what am I doing with my Tesla shares and my position? I like to be transparent here. I'm building this portfolio from $10,000 with the goal of building it to $1 million in the next 10 years. I update this in every video. We're at $23,200, down 11% overall. Not worried about that at all. We're down 3% on the day. But here's what I plan to do. Again, these are with new contributions that come in. We add $3,000 every month, and it's turned to auto invest, so it just automatically invests. So I've actually, because growth is selling off so much, I have moved the target percentage of these growth positions in my portfolio to 89%, and dividend to 1%, and kept crypto at 10. This is not going to sell anything down to hit that target. Because I'm adding new money, I'm just going to let it add more to the growth positions, and it will eventually get those positions up to 89%, and the dividend growers will move down. If growth comes back and I think that the opportunity is less in growth, then I can adjust that again so that the dividend companies start to get more of my contributions. Again, I'm not selling anything. It's just where new money is going by the way I have it set up. And I've actually upped Tesla to a 15% position, and it's currently 10. So Tesla will be getting new money when it comes in. GitLab is a 15% position. Amazon is a 10% position. CrowdStrike 15%, and Snowflake 15%. And I've moved some of these other ones down. Again, I'm not going to sell anything. It's just these are where I think the best opportunities are. So as new money hits the account, I don't want to have to worry about it. It's going to go to the positions that I am most confident in right now. And again, we're at the early stages of this portfolio. So I have a lot more money coming in over time. So I'm comfortable with these positions being a larger part of the portfolio since I have more money coming in later. And this isn't money that I need in the next 3 years or 5 years. It's designed to be a 10-year project. This, in my mind, is something that for when our kids are ready to go to school or college or whatever that looks like in 10 years, and we might need some money. That's, in my mind, what I'm building this portfolio for. Hope you enjoyed the video. If you like this content, give it a like, subscribe to the channel. And I love doing stock reviews. So if you have a stock you want me to review, leave it in the comments and I'll do a subscriber special review of the stocks you asked me for.